Welcome to Canada-US Equity Compensation. My name's Warren Dueck, and I'm here with my colleague Atif Mir. Good morning, Atif.
Good morning, Warren. Good morning, everyone out there.
So we're going to talk about equity compensation. This is a complex subject, and there's rules unique to each country. And one of the things we will talk about, this is a Tax 101 course, not a Tax 401 course. But, when you deal with Canada and the US, we do a lot of things alike between Canada and the US. But it's really the differences that count. And this is a particularly tricky area because oftentimes there's not a lot of guidance associated with it. And so equity compensation, the whole idea of equity compensation is you're being compensated with shares of the corporation. That may be employer, that may be the parent company of your employer. But the idea is you're getting shares or something equivalent to shares. And we'll talk about some of those differences, and there's several alternatives in exchange for your services. So this is a very interesting subject, and like I say, has a lot of complexity associated with it. We will have time for questions, so please put in your questions, and we'll be glad to answer those at the end. We might not be able to get every question. Try not to get too personal detail. We might have to take those offline. So, but if you have some general questions, that'd be great. There will be a survey at the end of the course, and as soon as you log off, you'll get a survey. So we appreciate your input. We always love hearing ideas saying, hey, I'd love to hear about this idea. We're getting better at this as we go along. So we appreciate your input. And there's also, you can get a live transcript, closed captioning on this too. Zoom allows for that. Our agenda today is we're going to talk about the purpose of stock option, the different types, tax treatment. And lastly, we'll talk about some issues about moving to US and Canada. Some of those will be actually interspersed with our discussion. So what's the purpose of stock options? Well, there's lots of different reasons here, and here's 4 of them. One is that you actually get economic participation by employees. Owners of businesses love it when their employees act as if they're owners. In other words, that they're interested in how they can reduce costs, how they can maximize revenue. So stock options and different types of equity compensation essentially reward employees like owners. It also lines up success and compensation. If the business is fabulously successful, their compensation would reflect that. Some of the stock option has been particularly strong in the tech sector. That's for one of our last reasons there, that it improves cash flow for startups. So, the tech sector oftentimes has very little cash. They've got an idea, but no cash. So they pay employees with shares. And that can end up with a fabulous result. And it also builds that connection the employee has with work. Now, there's probably lots of other reasons we could add here too. I don't know if you had any other ones, Atif, for us, but
no, you've covered all the major ones here. Would just like to add one thing that, you can compensate an employee with a salary, with a bonus, and when you give them stock options or something equivalent to that, using your words, you're making it visible or more tangible, if I can use that word, to see how much the company is growing, and they can evaluate their growth with it financially, with the company better, as opposed to other options.
Yeah, that's excellent. So I'll turn this over to you, Atif, and talk about different types of equity-based compensation plans.
Thank you, Warren. So there is a stock option, vanilla stock option. You have the right to buy the shares in the company. And then there are other options, units. You can call them phantom equity, meaning that you're not getting the real shares, but what you are getting is something that which the value of which is computed in reference to the shares. And those options are, or those those phantom equity are restricted share units, deferred share units, and share appreciation rights. So that's the four pieces we are going to cover today in our presentation.
Now, the majority of equity-based compensation is really focused on stock options. That's the thing that's most common to people. And but all these there are little nuances with each one that's just a little bit different in how they work and how they're taxed. And that's one of the big issues there. Stock options, though, are the most common things. And with each one of these, there's usually the requirement of either time or performance. In other words, you don't get the stock up front necessarily. You may get it in some cases at some future point in time, but it's either the passage of time or achieving certain performance targets associated with it, or a combination of both, actually.
Right.
Did you want to go to the next slide?
Yes.
Okay, so I'll talk about Canadian stock options. I'll leave it to you here, Atif.
Thank you, Warren. So I'll give a couple of seconds to the viewers to get their eyes warmed up to the slide that is in front of them. There's a lot of information summarized in a chart form. So take a look at it, and then we will talk about it. So I'm going to just do a 2-second silence here, just for you to take it all in. So what I want you to start looking at is that there is a non-CCPC column here.
And what's CCPC?
Canadian Controlled Private Corporation. Thanks, Warren. We tax people often focus on acronyms too much. Thanks for catching on that. Canadian Controlled Private Corporations. So there are two scenarios that are being captured in this slide: non-Canadian Controlled Private Corporations / public corporations, and Canadian Controlled Private Corporations. So Canadian government wants to encourage private corporation business. So there is a little bit more benefit when the stock options are issued by a Canadian controlled corporation, as we will see when we walk through this chart. So the life of stock option is, you can separate it in 3 stages. One, when it is granted, when it is exercised, and when it is sold. So let's look at a non-CCPC, non-Canadian controlled private corporation / public corporation. So when the options are granted, there is no tax. The employee receives the options. They do not need to pay any tax on it. When the options are exercised, then there is employment income, and there is you have to report the employment income on your T4 slip. And when the shares are sold, then you report capital gain. Now, let's take a look at the Canadian Controlled Private Corporation.
Before you go there, Atif, in the first 2 columns there, or the columns under non-CCPC public corporation, firstly, I mean, just as a point of clarification, public corporation means publicly traded corporations.
Correct.
Not government corporations.
Yeah.
Though I guess they could fall into that category, couldn't they? But it's for the broader publicly traded corporations. So what distinguishes those 2 columns? One you have employment income, and one has a 50% deduction.
So there is so in some cases, if certain conditions are met, then you can, instead of including the full employment income on the T4, you can get a 50% deduction on your employment income. So that is the benefit if you meet certain conditions. And I'll come to it in a second in more detail, but thanks for pointing that out, Warren.
So just for our audience here, I mean, with if they get $100 of employment income, they get a 50% deduction. They're only taxable on $50, not on the 100. So that basically, in terms of tax, if they're resident of BC, that would reduce their tax rate from 54% down to essentially 27%.
That is correct.
Only being taxed on half it. So that is a really significant item. And for those people that are US people in our crowd here, and we have a bunch, they're going to end up potentially with a higher US tax rate than their Canadian tax rate. And we always think of Canada as being not a great tax location. But here's a case where the US tax can be much higher than the Canadian tax.
Yes, thanks for making another case that Canada is tax haven. So, so if you look at the column for Canadian controlled private corporation, so when the options are granted, there is no tax. When the options are exercised, still no tax. And when the shares are sold, then there is employment income, and you get that 50% deduction if conditions are met, and you report the capital gain. So if you could take a look at the Canadian controlled private corporation column, it's much better tax outcome as opposed to non-CCPC / public corporations, relatively speaking. Now, how does the half-year deduction work? Who qualifies? So there are certain conditions that need to be met, just high level. The shares have to be prescribed shares. And if they are not prescribed shares, you do not get 50% deduction. What are the prescribed shares? There is a list of things to go through, but just to give you a flavor of it, that it's not a prescribed share where the holder has the ability to cause the shares to be redeemed or acquired or canceled by the corporation. So that condition needs to be met. And the other condition is that you need to hold the shares for at least 2 years. And there should be an arm's length relationship between employer and employee. Now, without going into too much detail, those are some of the conditions that need to be met before you fall into that 50% deduction. So when you are laying down the stock option agreements, you have to be careful how you structure those agreements so that you don't fall offside or you avoid or you fail to benefit from that 50% deduction.
So I mean, in terms of stock options, you typically see stock options in private companies, ones that have a plan to often be widely held, maybe publicly traded, but you don't often see just a standard stock option in a closely held company. It's not impossible, but it's just not as common. So typically those sort of factors like you talked about, being able to have the shares redeemed and things like that, look a lot more like more widely held entities. In other words, you can't control those things.
Right. And just to take it further, that there is a tendency to be resistant to issuing stock options in CCPC, even though the benefits are more compared to the other scenarios, non-CCPC / public, is because if you bring in some people in to make them a minority shareholder, and then tomorrow you have to sell the company, then minority shareholder, will they have a say in selling letting you to sell that company? And that's where potentially a shareholder agreement can come into play, that if an offer is received, what is the role of the minority shareholders in accepting or rejecting that offer? So things to watch out for when you're dealing with CCPC. You want to benefit from the rules, but at the same time, you don't want to tie yourself completely from making big decisions down the road.
Yeah, I think that business owners have to think really carefully, if they own 100% of the business, about bringing in minority shareholders. Not that they're not valued and important employees, but those minority shareholders can be a real problem to especially closely held businesses. And there's some alternatives. We'll talk about some of those. Atif has already referred to them, the idea of phantom stock. It's kind of like stock, but it's actually not like stock, especially from a legal perspective with regards to minority shareholder rights.
Correct.
And just to, and we're going to go through an example here that actually walks through this, but I want to highlight it for people, is in the columns, particularly under non-CCPC public corporations, there's a tax at the exercise of the options. But when the shares are sold, you're not double taxing that gain. In other words, if I had a exercise an option I got for $10 that I could exercise for $10, but the value at the time of exercise was $100, I'd have a $90 gain. And then if I went and sold the shares a year later or 2 years later for $150, I'd have a $50 capital gain. So I'm not paying tax. I'm paying tax at both times, but it's on different amounts.
Right. And I think one of the example will cover it a little bit. Warren, you're trying to steal my thunder there.
Oh, sorry about that.
No, I'm just kidding. And thanks for bringing that up. That's a critical point. So,
You want to move to the next slide?
yes, please. So just briefly to touch upon the new rules that came out a couple of years ago, and they restrict the stock option deduction. Essentially what it says is that if the consolidated revenue is greater than $500 million and the share value at the grant is, let me start again. Let me not confuse the issue. I think I'm going from the other side here. If you want to get a benefit from the half deduction that we talked about in the previous slide, then there's a limit, that $200,000 annual benefit limit is imposed, that the vesting will apply, the shares will be vested, and the benefit will be delivered, the half deduction benefit, if the value of the vesting is at least $200,000. So that's a new rule, imposes a little bit of limit on certain things, so just to be cognizant of. Warren, you want to make any comments there?
No, I think it's, I mean, this is a challenge. I just think of this in a broader context. I mean, Canada's been very successful attracting people to Canada, particularly in our tech industry, that based on stock options, because Canada's generally a high tax country, but this is a situation where it's not. But these rules start to limit, saying, oh, we're actually only interested in successful small companies. Now that sounds very politically attractive, but I think we want to attract people. We want to have our big winners also be super successful too. So this is a real challenge for Canada, that you've got some people paying tax on employment income at 54%, other people paying at 27% effectively. And why are we making these differences? There's a bigger political issue at stake here, but as a Canadian, we need to be competitive, and we need to have the best people, whether they're coming from the US, whether they're coming from Uruguay or Australia. It doesn't matter. We need the best people here, and this restriction limits that. So
right,
that's unfortunate.
Right. So if your company revenue is more than $500 million, then yes, there's a limit imposed on how much benefit you can get out of that 50% deduction.
Yeah.
By the way, just to add, that $200,000 value is based on the value at the time of the grant.
And those are all Canadian dollars too, by the way.
Correct.
And so there's actually, I mean, there's a lot of people that still will fit into this category, that they'll get the benefit, but and your employer should know the answer, by the way, when that happens. But there's people that are getting limited out on this, and it means that trying to pick a name out, but the stock options of Suncor or TELUS are probably not in here. They're going to be subject to that $200,000 annual limit.
Right.
And 200,000 sounds like a lot of money, but it's actually pretty small in the scheme of things about people's stock options, where people are realizing gains of literally millions and tens of millions. Now
Right, and as you were saying, to attract the best talent, you have to pay bigger dollars. So yes, that limit becomes pretty small pretty quickly.
Yeah, yeah. Next slide. You want to do the example?
Yes, please. So whatever we have talked about so far, we thought we will just give you an example to make sure everything is crystallized in practically. So think about a situation where there is a Canadian controlled private corporation and the consolidated revenue is less than $500 million. And the option price is $110, meaning that you have the right to buy the shares at $110. Now, at the time of the grant, the fair market value of the share is $100, which is less than the option price. And the exercise price is $180, fair market value. And at the time of the disposition, the value is $240. Now, these are the fact pattern, and then we will walk through the calculation here and discuss in a little bit more detail here how it works. So if you refer back to the slide that we had the chart on, which talked about that how if certain conditions are met, and it's a CCPC, which it is in this case, Canadian Controlled Private Corporation, then you don't have to pay tax at the time when the shares are granted, when the option is granted, and when the option is exercised. You only pay when you dispose of the shares. You pay tax at the time of disposition. That's why if you look at the tax at top marginal rate column, under that, we are saying on disposition, the Canadian tax is $35 instead of saying at the time of exercise, because the conditions have been met, so the tax comes into play at the time of disposition. And the way, how did we come up with that $35? So if you look at the disposition, that's $240. The option price is $110, so that's your $130 profit, and then the rate is 27%. So you end up with Canadian tax of $35. And because they qualify for half 50% deduction in this situation, so we have just used the simplified calculation here, just calculating 50% on the tax. Any comments, Warren?
No, it looks like a pretty good deal, actually. I mean, you've got something you bought for 110, it sold for 240, you got a $130 gain, and you're only paying $35 of tax. I mean, that's a great benefit for people. That's huge. That's a very significant win.
Right. Correct.
Should we talk about US citizens in Canada on that one?
Yes.
So I already tipped you off saying if a US citizen lives in Canada, they have to pay tax on their Canadian stock options too. But they'd have to pay tax, even though Canada defers the tax, in the US, they'd have to pay some tax on the exercise of the options. Now, there is an exception here. We'll talk about that a little bit later, but in most cases, they'll pay on the exercise of the option. So they got to put $26 out in the year they exercise. Let's say that's 2023. Even though they don't pay the Canadian tax till later. You already can see at the bottom that they're going to pay a total of $41 of tax, which is more than 35. They'll actually end up being able to use the Canadian tax as a credit against the US tax. But remember, we're incurring US tax first. And there is a potential here that the total tax is not $41 of the combined US and Canadian tax, not $41, but could actually be closer to $60 because of the mismatch of foreign tax credits here. So US citizens living in Canada get options, need to be very careful. And there's another secret in here too, that oftentimes, and people who prepare US tax returns, their goal in their mind is to eliminate the US tax. I agree with them, that's their goal. But they take a shortcut to doing it. And by claiming the foreign earned income exclusion, you can exclude about $100,000 of income earned in Canada from US tax. But it costs you something kind of invisibly. It reduces the foreign tax credits you can use to offset your US tax on Canadian source income. Here's a case where those foreign tax credits are gold. And potentially a US citizen could reduce their total tax to the $35 paid in Canada if they literally prepared their tax returns in the appropriate manner. This is often not done because those foreign tax credits are worth, well, you can carry forward up to 10 years. So, you know, all that time you've been earning income in Canada and you've been paying a bunch more Canadian tax than you would pay in the US for the privilege of living in Canada, those taxes carry forward to offset a situation where you'd pay US tax and your Canadian tax would be lower. This is a sort of thing that you need to pay attention to. And you should be asking your tax return preparer, are you claiming the foreign earned income exclusion? Because I don't think you should. And they can listen to this webinar if they want to do that. So does it seem too good to be true that suddenly the US tax is higher than the Canadian tax? Don't you feel like you're pretty lucky to be living in Canada, Atif?
Yes, I do. Except that it's a little bit cold in Alberta. It's pretty good here, tax-wise.
Yeah, yeah. No, that's absolutely true. So we're going to flip over to stock options here, to US stock options. So the US, it kind of breaks down to two groups, qualified, and the US talks about qualified stock options and non-qualified stock options. The qualified stock option is also referred to as incentive stock options. Now that's just a term of US tax law. And it would tax the gain at 20%. Now that's essentially the capital gain tax rate. But it requires them to meet holding periods. In other words, after they exercise the option, they have to hold on to the stock for at least another year. There's certain other criteria that's required too. So there's no regular tax on the grant of the stock option or in the exercise of the stock option. And that parallels Canadian tax treatment. But the US does apply alternative minimum tax, and that tax rate goes up to 28% on the exercise of the stock option. So you're going to end up paying some tax, and that usually means, you know, if you have the good fortune of realizing $1 million incentive stock option, you may have to pay $250,000 of tax up front, which typically means you've got to liquidate some of your shares to get to pay the tax, unless you've got cash independently. So there's a challenge here. This, you can see there's some complexity building to this. That tax, that alternative minimum tax, is actually a prepayment of the tax you'd otherwise pay. Because with an incentive stock option, if you meet the holding period, you'll still have regular tax on the ultimate disposition, and you'll be able to claim that AMT credit as a credit to offset the regular tax. Now, there's a whole lot of complexity there, and you can see incentive stock options sound wonderful. They may not be as wonderful as you'd hope them to be, and they're not that common. It's we're going to talk about non-qualified options second here, but incentive stock options are not as common as you think, because they seem to have a big tax win, but they come at a price, and that price is you got to pay that alternative minimum tax, and you have to hold the stock for a year after you exercise. One of the things here I want to mention that people don't think about is oh, US stock options, an incentive stock option must come from a US employer. So if I was working for a US company, I'd have this problem. I'm going to say au contraire, that does not apply. In other words, someone can have an incentive stock option that's issued by a Canadian corporation. As long as the option meets the requirements of US tax law, which are pretty broad, it can qualify. So even though you're working for Suncor or TELUS, you could unexpectedly have an incentive stock option. Now, that's only relevant if you're a US citizen or if you're a green card holder living in Canada. So it wouldn't apply to other Canadian residents, but it can apply. The issuer of the stock option can avoid that by specifically stating in the option agreement that it is not an incentive stock option. So it's easy to avoid, but be aware that incentive stock options can be issued by US companies, by Canadian companies, by Brazilian companies and French companies and wherever you're at. So they have a very broad application there. So I'll flip to the next part here, non-qualified. We talked about qualified options, incentive stock options, and now we'll talk about non-qualified stock options. You can see their gains are taxed at 37%. That's the top marginal ordinary income tax rate in the US federally. If you live in a state, you'll have a state income tax issue there too. There's no regular tax on grant. And if you then sell the stock, but you'll pay tax on exercise, you won't pay it on the grant. And when you actually dispose the stock after exercise, you'll actually have a capital gain or loss, but only on the increase in value after exercise. So those are the qualified and non-qualified options in the US. Did you have any questions on those, Atif?
No, I'm just thinking that so at the exercise, you're paying more tax. It's an alternative minimum tax versus the tax at the time of exercise between these two, correct?
That's really right, and that's a great point because despite the tax benefits under qualified options, non-qualified options are still the choice that most people make, that most employers make, because to the employer, they have no cash out until, with a non-qualified option, until they exercise. And they solve that problem by exercising and selling the shares the same day. They're going to pay a 37% tax rate on it, but they can pay off their tax. They have no risk there. Aside from that, that 30 seconds between exercise and sale of the shares, they have no risk in that time period. Whereas with the incentive stock option, you got to put out that potentially 28% tax rate. If you have $1 million gain, you'd have $280,000 of tax you'd have to pay. And you have to hold it for a year before you sell to get that treatment. So it's really a cash problem. The incentive stock options require a lot of cash, and that's a problem.
Mm-hmm.
Should we go to our example here?
Yes.
So, and we do a comparison here. So the payer is a corporation. The option price is $110. The fair market value of the shares is $100 at the date of grant. So you'll see here, the option price has to be higher than the fair market value of the date of grant. Otherwise, you've got a taxable benefit when you actually receive the grant, if it's lower than that. In here, we've got, it's $180 at exercise and $240 at disposition. Same facts as we had in that Canadian example. If it's an incentive stock option and the holding period is met, then the US tax is $20 on exercise. Remember, that's the alternative minimum tax. And you can see the computation there because the value was $180 at exercise. The gain is the 180 minus the 110. 110 is the option price. And you'll pay 28% with alternative minimum tax on exercise. When you sell the shares after the holding period is met, that's a year after the exercise, then now you're selling it for $240. you never paid regular tax on the $110, the difference between that. So you're going to pay regular tax on that. And then you're going to credit for the alternative minimum tax. I told you this was confusing. The $20 you paid up ahead. So you pay an extra $11, you're paying $31 in total. Now, aside from the fact that you're cash poor in this situation, the ISO gets a better tax result. The incentive stock option does. So that sounds great. Now, if you had a non-qualified stock option, the NSO, then on exercise, you'd pay tax at 37% on exercise. That's the difference between the $180 and $110. And then you also have a capital gains tax at 24%. I'll explain that 24% in just a second here. That's the difference between the 240 and the 180 on disposition. So the 24% is a 20% capital gain rate, plus it's the Obamacare tax. It's actually 3.8% adds on top. That's where you get the 24%. To get that low rate of tax, you had to hold it for 12 months. If you don't hold it for 12 months, it's a 37% rate plus Obamacare tax. So you could end up with essentially a 41% rate there. But you can see the non-qualified stock option is more expensive, but still is the preferred result, proving that our example here that despite the fact we're tax guys, tax isn't always the most important thing. Cash is. Everybody wants cash and they don't want to give it up. And that's what happens when you have an incentive stock option. So you got to have the cash to make that work.
Mm-hmm.
Is that a pretty good deal?
I think so. And just to reiterate what you just said, if I look at the two calculations and if I look at the numbers inside the bracket, in the second case, the calculation is split up between 180 minus 110 and 240 minus 180. So the whole gain has been captured under two different tax rates. But in the first example, we are capturing the full amount, 240 minus 110, the full gain, because AMT was just a tax imposed on exercise for which we are getting a credit later on. So we jumped from 240 minus 110 on the first calculation in the second part.
Yep.
Second.
Yeah. I mean, if you have the cash, the incentive stock option is great. You got to hold the stock, remember, and you know, if you're with a company that's going up for the rest of its life, I just saw the Bernie Madoff Netflix example. So that he said he always made money, and you know that's a problem when someone says that. But you know, if you have the confidence, then maybe that 1 year holding period isn't such a big deal. If you've got the cash, that's great. But most of us will know in real life, life doesn't quite go in a straight line. And you know, the great company of 2022 is suddenly in the tank in 2023. Or maybe a better example is the cryptocurrency was on fire in 2021, and then it crashed into an ash heap in 2022. So too many of our listeners may know that situation personally, so I won't rub that in, but you just don't know what's happening in the future.
Correct.
So do you want to talk about restricted stock units?
Sure.
Well, that's me talking about restricted stock
I
units.
think that was your slide, but
Okay. So restricted stock units, the idea here is that people receive restricted stock units. There's a number of names. They often get referred by their acronym RSUs. The units derive from the value of the shares. And when they vest, they become taxable. And I'm going to talk a little bit more about that in a moment. So their taxable benefit is when they vest is the value of shares in the cash received. So if you are in a restricted stock unit plan and you receive, you know, 10,000, and your employer says we're going to give you 10,000 shares in, you know, the next 4 years, so 2,500 shares each year you'll get. When you receive those shares after year one, you'll receive 2,500 shares. And if they're at $1 each, then they're worth $2,500. They may be worth almost nothing today. And in 2 years, when they're worth not $1, but they're worth $5, you'd get, they'd be worth $6,250. And in that tranche you received in year 2. And in year 3, you get another 2,500 shares. Now they're worth $10 each. That'd be worth $25,000. And you'll pay ordinary income tax rates on each tranche based on the value they're at when you actually receive them, when they vest. Now, you can structure these to avoid Canada's salary deferral arrangement rules. And Atif, do you want to kind of share with the audience just how these salary deferral arrangement rules could affect these if it's not structured properly?
Right. So as it says, the title says salary deferral arrangement, the CRA doesn't want that if you earn a salary this year, but you asked your employer that, hey, can you wait to pay me after 4 years or 5 years when I'm in the lower income tax bracket? And what you're doing is you're deferring your tax even though you have earned that salary. And that, if you are doing that, then you're caught under the rules of salary deferral arrangement. And there is a risk that phantom equity stocks, restricted stock units, for example, might be captured under those rules. But there are certain exceptions listed out in salary deferral arrangement that can be met to make sure that you are not caught by those rules. So what we are saying here is that care should be taken to make sure that when you draft the agreements, that you have made sure that you are not falling into those particular rules.
Right, and there's some very specific US rules we've identified there too. If you're the beneficiary, if you're the recipient of restricted stock units, and you're granted these, you have an ability to make an election. I'd love to call it some sort of really interesting name, but the interesting name is Internal Revenue Code Section 83B. I warn our people never to use code sections on this, but sometimes you don't have a choice. If you make that election within 30 days, it can have a very positive result for you. Remember, in the case I kind of walked through, I said, well, maybe the shares are worth, 1 cent today. In 1 year, they're worth $1. And then in 2 years, they're worth, $5. And 3 years are worth $10. If I make that election, that Section 83B election, there's certain requirements associated with it. That includes something called the substantial risk of forfeiture, which just means you don't know you're going to get those shares. Because you have to be employed at the end of year 1, year 2, year 3 with that employer. But if you make that election, that means when you receive the grant of shares, not the shares themselves, but when you say, hey, we'll pay these to you in those future times, you're electing to pay tax on that income today. And so you'll pay tax in that year based on the value today. So, it's 10,000 shares at, 1 penny each. I think if my math is right, that means you'd have a gain of $100. And so you'd pay tax on the $100. Now, that's way better than paying tax on $1,000. And we talked about $6,000 and $25,000. So that's a really good deal. You'd pay tax today on that. When you actually receive the shares, you wouldn't have a tax event, but you would pay tax when you sell the shares. And that may be 20 years from now. So you'd have reduced your US tax. Now, you still, if you're in Canada, you'd still have a Canadian tax to pay. If you're in the US, of course, you'd only pay US tax, that amount. So there's definitely a win there. That's making that election. Now, I made a comment earlier saying vesting. Canada and the US both use the same word, vesting. But like a lot of things, Canada and the US are similar. It's the differences that are important here. In the US, someone can receive dividends on restricted stock units. They can sometimes vote their shares prior to vesting and without any adverse US tax implications. For Canadian tax purposes, having those rights would be equivalent to you owning the stock. So Canada would say, if you have those rights, you're taxable on them now. Well, that's why, and this is where it becomes very interesting on larger companies. That's why, and I don't know the specific, I'm just using this name, why Amazon will have an Amazon US RSU plan and an Amazon Canadian RSU plan, because they're different plans. If you're an employee moving from the US and coming to Canada, there may be a real Canadian tax win for you there. And I wish I could say the same would be true about Canadians moving with Canadian plans to the US, but how these two interact become very important and may have some, may create a tax planning opportunity for you. Questions on that, Atif?
No, I think you've covered it pretty comprehensively. I'll just add one comment that there is an exception under salary deferral arrangement, going back to the Canadian rules briefly, that says that the payment should be made within 3 years. And it's one of those exceptions where restricted stock units are effective or can come into play. So you have to draft your agreements to make sure that you fall into that particular exception. Just wanted to add that comment.
Okay. Share appreciation rights, Atif, I'll let you run with this.
So taking the points that Warren has already made and building on it. So share appreciation rights, just to reiterate, is a similar concept, if not the same as restricted stock unit, in terms of that they are phantom equity. They are not, the employee is not receiving the shares. What employee is receiving is something that is computed in reference to the share price. Hence, the compensation is linked to the stock price. So if the stock price does well, then the employee does well, even though they do not own the shares. So if there is no exercise price involved for the same reason, and the cash is received when the shares are vested. Again, going back to the comment that Warren made, vested means different things in US and Canada, something to be cognizant of, maybe having two different agreements, as Warren was saying, Amazon USA, Amazon Canada. And again, there is a risk here that this arrangement could be targeted as, hey, employee, you are getting your salary deferred into the future, so we are going to tax you now. And when I'm speaking in quoting this, I'm pretending to the CRA. The CRA can come and ask the employee to include that in your income. But the share appreciation rights, it has been confirmed by the CRA that it is in relation to the future growth of the company. So it is not something that in relation to what the employee has, services that the employee has already performed. So for that particular reason, it will not fall into salary deferral arrangement, because the compensation that the employee is going to be receiving is going to be for the future, not something that the employee has already done. For example, if the employee says to the employer that I'm taking a sabbatical after 3 years, I'll be in the low income tax bracket, give me the salary at that time for the money that I have earned already. I've already performed the services. That's a salary deferral arrangement. But in this case, share appreciation rights, what is happening is that the CRA has agreed that the value starts accruing of the compensation going into the future. So that technically the services have not been performed yet. That's why they do not fall into salary deferral arrangement, meaning that they will not be taxed right now at the time when these rights are issued. Does that make sense for you, Warren, from US perspective?
Yeah, I think that, I mean, share appreciation rights are a kind of phantom stock where and these, I really like these with private companies that never intend to go public or in public markets, and where you've got a shareholder that's in place there, that they're able to hold on to these shares, or they get the same rights as the shares, I should say, but they actually the employee never actually becomes a shareholder, and so you don't have that minority shareholder situation that you might otherwise have. So I'm a big fan of that.
Correct. And deferred share plans, again, phantom stocks. They're hypothetical units, and they're granted based on position, length of employment, company's performance. Now, again, the CRA might argue and say that, hey, hold on a second, you are deferring the inclusion of compensation in the tax return by issuing deferred share plans. And if they need to be paid beyond the 3-year period, then you need to pay tax on it now, because you're captured again by the salary deferral arrangement. This is the concept that you will constantly hear when you talk about phantom stocks, salary deferral arrangement. So just like we discussed before in context of restricted stock units, we will see, hold on a second, is there an exception here available under salary deferral arrangement that allows me to structure these plans? And there is. And the exception is that if you are issuing these plans and they will become payable when the person retires, even though that might be after 3 years, or the person dies, or if the person is let go, then these plans are not taxed now. They do not fall in under salary deferral arrangement. They meet the exception. So these plans are very effective when you are structuring a plan, a stock plan or a phantom stock plan to compensate someone who might be retiring. There's a death situation or possible death in the future. Well, it's always in the future. And if it is linked to the loss of the employment. Again, they are notional units and they're linked to the share price. So all these deferred share plans, share appreciation rights, and restricted stock units, they're linked to the stock price. They're structured differently, and they are drafted in a way to make sure that it do not fall into salary deferral arrangements.
You know what I love, you've proved my point, Atif, for that anything with a special name is a bad thing, and when you talk about taxes. So whenever you hear the word salary deferral arrangement, oh no, Canada's going up. Canada loves that sort of stuff, and not the US is immune to it. But I love how Canadian tax law seems to focus on those sort of things. And arguably we should thank our finance minister for that sort of stuff, but that's the way it is. But there's lots of different alternatives here, and we've only talked about a handful of them. There's every variation here. There's aside from the salary deferral arrangement rules in Canada and the qualified versus non-qualified rules in the US, there's a lot of room to move here if you're an employer trying to structure a plan. There's a lot of flexibility there. But of course, you want to be concerned about saying, when do people have to pay tax? Because that'll influence that decision. So let's flip and talk about Canadians moving to the US. And this is just some real quick stuff here. Canada, if you move to the US, you'll have a deemed disposition for under Canada's departure tax rules that said you treat like you sold everything. The good news is, if you hold stock options, you don't own anything. You have a right to future income, but you don't own property when you leave. So that would not be subject to deemed disposition. Stock options are a tricky subject. in terms of who gets, a lot of Canadian and US tax laws, who gets to tax the income first. And Canada for years held, in my opinion, a totally untenable view that said if it was granted while you're resident in Canada, Canada had full taxing rights associated with. The US said, no way, you're taxed on where you worked and what the value was is allocated between the two countries. That the treaty actually confirms that now, and has some treaty sourcing rules there too. So, what you need to still, the aspect of moving the US is still a broader topic and a bigger one that than just holding on to stock options and other forms of equity compensation. You need to make a determination saying, do I actually own property, or is this a future right to property? So I don't know if you have any comments on that, to Atif.
Now, just to reiterate what you have essentially captured here, that if you have received stock options and you were living in Canada and then you move to the US, be careful, watch out for the interplay of the rules between Canada and US to make sure you don't get trapped in anything that you don't want to be.
Yeah, and when we didn't have a second slide that talks about, moving to Canada, there are some significant potential there that you can reduce your tax rate. And I'll say, the incentive stock options is a great example, because if you have incentive stock options, you've got to pay that 28% US tax on that's the alternative minimum tax. But if you move to Canada and meet the holding period, you escape any further US tax on that. And when you come to Canada, since you've already exercised these shares, you get fair market value at the time you move to Canada as your Canadian tax basis. So if you buy these shares for $1 or exercise them for $1, now they're worth $10. You move to Canada and you sell them for $12, you'd only pay Canadian tax on $2, and you wouldn't have any further US tax. So there's some real potential. You should always be thinking of this, is moving from one country to another has potential significant tax opportunities. And it also has the reverse. You can end up with adverse tax situations. So it's not always a win, but there are wins there. And in the heady years of Silicon Valley, which kind of stopped sometime earlier last year, there were a lot of Canadians working in Silicon Valley that returned home with large tranches of options or incentive stock options, restricted share units, and there are tax planning opportunities that went with that nobody ever really thought about, except for hopefully if you're one of those people who received them, you were thinking about that. So we're going to move on, unless you had other comments, Atif, to questions and answers.
Now let's move to the question and answers.
Okay. Hey, if you've been with us this whole time, thank you for being with us. It's pulling up right about 10 o'clock Pacific time here. You're welcome to stay on with us. We'll take some questions, and if you need to leave, thanks for joining us. Do complete the survey, and we look forward to hearing from you and having you join us again. So Lena Samin is our question taker. And Lena, can you, what's our first question?
Thank you, Warren and Atif. We have received a few questions. The first question I have is, if I work in Canada and receive stock options from a Canadian corporation, how are they taxed in the US?
Good question. What happens there, I mean, like I say, Canada, US, both, if you're a US citizen, and did the person say they were a US citizen?
They didn't specify.
Okay, well, if they're in Canada and they'd only be taxed on the US if they're a US citizen or they're a green card holder. And if they receive those, then they'll pay US tax too. And those options will depend on, we talked about earlier, if they're stock options, they'd be taxed as ordinary income in the US. That's the 37% tax rate. So, we said in Canada, those options might be taxed as low as 27% for a resident of BC. Ontario is about the same rate. Alberta is a little less than that. But if those options are incentive stock options, remember we said that a Canadian company can unintentionally issue incentive stock options. If they qualify as incentive stock options, the individual will have an alternative minimum tax obligation on exercise. And when they actually sell the shares, they pay tax at that point in time.
Thank you, Warren. I have a second question, Atif, for you. Can you explain the salary defer arrangement a bit more?
So we covered some of it already, but just to reiterate and maybe elaborate further, that if there are some cases that were happening where an employee, even though he or she has performed a certain service, will say to the employer that, hey, I'm going to take some time off a few years down the road or a couple of years down the road. Can I get the pay at that time? Because I'll be at low income tax bracket for whatever reason. And then pay less tax on the income that was earned this year or a prior year, or depending on the facts. So essentially what you have done is that even though you have earned the salary, but you have delayed the receipt of it in the future year at a more favorable time for whatever reason in terms of tax. So CRA came back and said, no, this is not good. You cannot defer the tax on something that you should be paying tax now. They came up with the idea of salary deferral arrangements. And they said that if you're captured by these rules, you will have to pay the tax now, not down the road. However, to allow certain situations, including restricted stock units or deferred share units that we talked about, they put some exceptions there that if the payment is made within a certain time frame and it's a bonus, or if it relates to termination of employment or death or retirement, then we will allow certain exceptions. So that's the idea for the salary deferral arrangement. And to link it back to our presentation, and it happens that when you're drafting these phantom stock agreements, you might fall into the salary deferral arrangement. So we have to make sure when you're drafting the agreements that you meet the certain exceptions, and then you will be treated as restricted stock unit, you'll be treated as deferred share units, and the tax will come into play later on.
So salary deferral arrangements, if you're subject to those rules, it's going to accelerate the recognition of income for tax purposes. In other words, you may not receive that $100,000 till year 3, but you're paying tax on year 1. That's an awful situation to have.
Yes, from cash flow perspective as well. Yeah.
So if you hear the word salary deferral arrangements, you got to protect yourself. What's next, Lena?
Thank you, Warren and Atif. I received restricted stock units working in the US that have not vested. Now I'm planning to return to Canada. Will I be subject to double tax on them?
Well, that's a good question. Restricted stock units are an interesting subject, as I mentioned before, is that what vested means, and Canada and the US use the same word, but it means different things. And this is maybe an opportunity here. If that individual has rights that would imply there's some element of ownership, and those are things like receiving dividends or being able to vote the shares and things like that, which US policy, US tax law allows without it being considered vesting, but Canada does not. It means if you have those rights associated with your shares and you come to Canada, you may end up with not paying Canadian tax on any appreciation of those units prior to coming to Canada. In other words, if the shares you have are worth $1,000, or the restricted stock units you have, the underlying shares are worth $1,000, and you come to Canada at that point in time, you would only be taxed on any gain, any appreciation above the $1,000 when you actually sell the shares. And that would be a capital gain. But if they were earned from services rendered in the US, then the US would tax not only any appreciation above the $1,000, but they'd also tax the $1,000. So, this is another situation where you have an advantage, potentially have an advantage with restricted stock units. We've seen some really unusual circumstances associated with restricted stock units. And they're one of those little things that people don't understand very well, particularly in the cross-border tax implications.
Thank you, Warren. I have one last question. I worked in California and received stock options from my work there for Apple. Will I be taxable in California on their sale now that I live in Texas? Would I be taxable if I return to Canada?
Well, generally, that's a good question. I mean, you'll be taxed on any option income. In other words, when you exercise the option, it triggers a gain, and the services that provided it were actually incurred entirely within California, then yes, you'd be taxable in California. Now, if they worked 3 years in California, then another year in Texas, they'd pay California tax on 3/4 of that because that was the portion allocable to California. The other quarter would, at least in theory, be taxable in Texas, but Texas does not have a state income tax, so it wouldn't be subject tax there. That same rule would apply if they moved to Canada. If they worked for an employer for 3 years in the US, then spent a year in Canada, 3/4 that would be allocable back to California and be taxable there. When the individual sells the underlying shares, and they live in Texas or Canada, they would not be subject to California tax on the gain on that sale. So, there's that may be an opportunity. We were talking about restricted stock units. Potentially they would avoid California tax on those restricted stock units then by moving, or reduce it by moving to another jurisdiction. So thanks very much for those questions, Lena. I appreciate you reading to us. And thank you very much for attending our session, everyone. And we look forward to seeing you again. Thank you.
Thank you, everyone.